Hello guys, welcome to Bhamna's Online Academy. In this video, we are going to see all the questions of AS20 which is given in the ICAI material. We are going to solve all the illustration plus your test your knowledge questions. So this is going to be a complete coverage video. But before that, if you haven't still watched the part 1 which covers all the concepts, I'll link the playlist in the description box below. Make sure to check that out, watch it, and then come to this part 2 so that you are able to understand the questions in a better manner. Yes. So without any further ado, let's begin with this video. So starting with the illustration number 1. So in illustration number 1, they tell you that 3 dates are given here and they have told you that you have to calculate the weighted number of shares. That means we read, right, weighted average number of shares, weights. That is what you have to find out, the denominator. Yes. So starting with the first one, they are saying that on 1st January, balance at the beginning of the year. If they are saying beginning of the year, that means the year is from Jan to December. So the year is from Jan to December. If January is the beginning of the year is going to be Jan to December. Okay. They had a opening shares of 1800 shares. So you are going to write in the beginning of the year, you have 1800 shares. I told you, right, if there is any opening shares which is held from the beginning of the year, you need not do any time adjustment here. So this is going to be all the entire 12 months you have held it. So 1800 into 12 by 12, 1800 will come in. Okay. Next is 31st May, they have issued some shares. Okay. So on 31st May, they have issued around 600 shares for cash. Okay. So here you have to see at which month they have issued. They have issued it at 31st May. That is the end of May month. That is in an year already 5 months have passed by from January to May. There are left 7 months only in the year. So for the 7 months, you have to now weight it. So 600 shares multiplied by 7 months divided by 12 months, which is 350 shares. So whenever a share is issued in between of the year, like I told you in the concept video, you have to do a time weight. You have to multiply it by a time weight. So since it is issued on 31st May, the number of months left after such issue is 7 months only. So 7 months multiply by 600 share. Okay, so that average you have to do. So if you do such average, it will be 350 shares. Next is on 1st November, they are doing buyback of shares. That means shares are being deducted from the company. How many shares are being deducted from the, or bought back from the investors or shareholders? 300 shares you are getting it from buyback by doing buyback from the shareholders. So 300 shares you are doing a buyback on 1st November. So until November, how many months have passed by? Already 10 months have passed by until the 1st of November. Only 2 months are left until the year end. So you have to see the 300 shares have been bought back from the company. How many months were left after the buyback? Only 2 months were left. So into 2 by 12. So 50 shares will be deducted. So if you do such average, then that will be 50 shares. So 50 shares will be deducted. So here if you see the calculation, so in the year beginning you had 1800 shares, then you issued around 600 shares in between of the year, so that became an average to 350 shares. Then you had done a buyback of 300 shares towards the end of the year, so that became an average of 50 shares. So 1800 shares plus 350 shares minus 50 shares, the total is going to be 2100 shares. Okay, so I hope you understood how to do this. So this was all about your illustration number 1. Now moving on to illustration number 2. So when you see illustration number 2, again they are saying that you have to calculate the weighted average number of shares only. Again the denominator weights you have to find out. Okay, so here what is different is, here they have given, apart from you have to do time adjustment, apart from that here they have given you paid up value also. So here when you do the calculation, you have to take the number of shares. If there is any time adjustment, you have to do such time adjustment as well, multiplied by, since paid up value is given, that is there is a different face value and a different paid up value, then you have to do how much is the paid up value divided by how much is the total face value also. Okay, so this also I taught you in the concept video. I hope you remember this. Okay, so they are saying balance at the beginning of the year was 1800 shares. So in the beginning of the year, you had around 1800 shares. 10 rupees was the face value and the entire 10 rupees have been paid up. So into 10 by 10, and it was with you during the whole year. So into 12 by 12. So 1800 will be the number of shares. Okay, on 31st October, what happened? You issued some shares. Okay, so if you see on 31st October, so after 31st October, how many months are left? After 31st October for the year end, how many months are left? Only 2 months are left in hand. Okay, so this will be your time weight. So 600 shares into 2 by 12. Now here if you see, they have said that the paid up value is 5 but the face value is 10. So you have only done a paid up value of 5 whereas the full face value is totally 10. So you will do 600 into 5 by 10 into 2 by 12. So both the time weight is also done and also the paid up value weight is also done. So both weight if you do, so you will get around 50 shares here. So if you add both of these, it is going to be 1800 plus 50, 1850 shares. I hope you understood illustration number 2 as well. Okay. Now let's move on to illustration number 3. So in illustration number 3, they are telling you to find out the basic earnings per share. So to find out the basic earnings per share, here you have to find out basic earnings per share for 2 years here. Okay. So they have given you net profit for 2001 also, for 2002 also. So here the year is going to be from Jan to December. Okay, the year is going to be from Jan to December because they have not given net profit for the year 1, 2. They have given it is a net profit for the year 1. Okay, that means only for 2001. That means complete year 2001. That is January to December. This is the profit. So from that you take the hint that this year is a calendar year. Okay. Fine. So starting with the basics earning per share calculation, first they have given you net profit for the previous year is 18 lakh, for the current year is 60 lakh rupees. Then they are telling you that the number of equity shares which was outstanding until 30th September 2002. 30th September 2002 is, that is in the current year, until 30th September. In the current year until 30th September you had around 20 lakh shares. Okay. After that what happened? So this is in the current year 2002. Jan it started until September end. You had around 20 lakh shares. After September end, what happened? That is on 1st October, you had a bonus issue. What did you have? You had something called as a bonus issue, in which you issued 2 equity shares for each equity share outstanding. That means for each share which was outstanding in the company, for every 1 share in the company, you issued how many shares? You issued 2 shares. You issued 2 shares. Correct? So here the ratio, here the ratio is going to be 2:1. That means for every share that you have held in the company, they issued 2 new equity shares. They issued 2 new equity shares. This happened in the year 2002. This happened in the year when? One second. This happened in the year 2002. Okay. So first let's find out the basic earnings per share for the year 2002 itself. So in the numerator what should come? Earnings must come. So what is the net profit for the year 2002? 60 lakh rupees. So here also you go and write 60 lakh rupees in the numerator. Then in the denominator you have to write weighted average number of shares. Weighted average number of shares. Okay, so I told you when you calculate weighted average number of shares, first you see that in the beginning of the year how many shares were there from the beginning of the year. Around here in the question they have told that you had around 20 lakh shares. You had around 20 lakh shares. Then in the mid of the year, or for let's say on 1st October, they issued something called as bonus shares. And how many bonus shares they issued? They said how many shares you were holding in the company, that is 20 lakh shares. For every share held in the company, I issued 2 shares. That means they issued around 40 lakh shares as bonus shares. They issued how many? 40 lakh shares as bonus shares. Now, for the shares which are held from the year beginning, should we do any time wait? You should not do any time wait here. Okay, the same way for bonus also I told you in the previous video that whenever a bonus shares is given in the question, you will never do time wait here. You will never do time wait here. Directly the total number of shares you will take it as it is. So it is going to be in the denominator 20 lakh which were already held in the company plus 40 lakh shares which were given as bonus. So totally 60 lakh. So 60 lakh by 60 lakh, 1 rupee will be the basic earning per share for the year 2002. Now when you come for the year 2001, originally what would have been the basic earnings per share in the previous year? In the previous year, the earning here was around 18 lakh rupees. So 18 lakh rupees would have been the earning. In previous year, there would have been no bonus shares. So 20 lakh rupees was the shares in the previous year. So 0.9 would be the actual basic earning per share in the previous year. But what did I tell you in the concept video? That you cannot compare these both. And why you cannot compare, all that reasoning also I gave it in the previous video itself. So please make sure to watch that to understand better. So I told you that if bonus shares are issued or if right shares are issued in the company, you have to find out something known as a restated basic earnings per share. A restated basic earnings per share. So when you find out the restated basic earnings per share for the previous year, for the year 2001, At that time, what you will do? You will take the numerator or earnings as it is, which is 18 lakh rupees. But in the denominator, you are going to assume that the bonus was issued in the previous year itself. That the bonus was issued in the previous year itself. So 20 lakh rupees was already there in the previous year. Now you assume that bonus was also issued in the previous year itself. So plus 40 lakh shares. So if it's going to be 18 lakh divided by 16 lakh, 0.3 was the basic earnings per share restated, basic earning per share restated for the previous year. So these are the three figures which they have found out in the question as well. Okay, so I hope you understood illustration number 3 as well clearly. Now moving on to illustration number 4. So illustration number 4, in the last illustration number 3 we saw about bonus issue. In this question we will be seeing about rights issue. Okay, so I hope you understood this. Here I have given the answer below for it, but now let's go through the question. So net profit they have given for the previous year is 11 lakh. For the current year it is 15 lakh rupees. Outstanding number of shares before the rights issue or prior to the rights issue was 5 lakh shares, and the rights issue price was 15 rupees. The last date to exercise the rights was 1st March. On 1st March is your right issue date. So this is nothing but your right issue date. Okay, and the rights issue is, so how much shares are they issuing as rights issue? One new share for each 5 share outstanding. So for every 5 share held in the company, you are going to get 1 share. So 1:5 is the ratio. That means already they were holding around 5 lakh shares in the company. So for every 5 lakh shares held, you will issue 1 lakh shares. You will issue 1 lakh shares. So that is what they have written here, that 1 lakh new shares were issued as rights shares. Okay. Then they are saying that the fair value of one equity share immediately prior to exercise of rights issue was 21 rupees. So they are saying that the market price before rights issue, was 21 rupees. It was 21 rupees. Now you have to find out basic earnings per share. Okay. So now let me just quickly take you through the notes of AS20, which I had also shared in the concept video with you. So here I told you, right? So whenever you are doing a rights issue, what you have to do? When you are doing the current year variance calculation, you have to find something known as risk adjustment factor. How will you find out risk adjustment factor? It is going to be market price per share divided by theoretical ex-right price. And theoretical ex-right price also, how you have to find out? I had given this formula. Okay, so first now what we are going to do in this question is, first we are going to find out the risk adjustment factor. Once you find out the risk adjustment factor, second thing we are going to do is find out the current year variance. And the third thing, then we will find out the previous year variance. Okay, got it. So now let's start with the question first. So starting with first, let's find out what is the risk adjustment factor. So risk adjustment factor is nothing but MPS divided by theoretical ex-right price. So MPS is directly given in the question. The market price per share is 21 rupees, or the fair value of one equity share is what the market price of the share. So that is 21 rupees, which is already clearly given in the question. This 20 rupees, this theoretical ex-right price is not given in the question, which is how we find out using the formula. So what is the formula? Formula is how much share was already held in the company. It was 5 lakh share. And what was the market price of that share? It was 21 rupees plus. How much shares are you giving at rights issue? You are issuing 1 lakh shares for rights issue. At what price? At 15 rupees. Divided by how much shares is already there in the company? 5 lakh plus how much shares you are going to give as rights issue plus 1 lakh. So if you do this by using this formula, you will get 20 rupees as your theoretical ex-right price, which you go and substitute here. So once you substitute this here, then 1.05 will be your risk adjustment factor. 1.05 will be your risk adjustment factor. Now using the risk adjustment factor, you have to find out the current year variance, or what we call as current year EPS as well. Okay. So current year variance, how do you find out? So now you are finding out the basic earnings per share for the current year. Okay, so the numerator is very easy. It is directly given in the question that current year we have made a profit of 15 lakh rupees. So 15 lakh rupees is written. But current year variance, when you find out, you have to use this formula, which I have given below here. You have to take that before rights issue, how many shares were there? 5 lakh shares were there, multiplied by the risk adjustment factor, multiplied by how many months were there prior to rights issue. So the rights issue happened on March. The rights issue happened on March, and here also they are following a calendar year of January to December. So if you are following a calendar year of January to December, then until March already it is happening on 1st March. That means until 1st March already 2 months have passed by, and you will have remaining 10 months. So after first 2 months itself, they are issuing rights issue. So for the first 2 months, this was prior to rights issue. Plus, How many shares were there after rights issue? So it was 5 lakh plus 1 lakh shares. So totally 6 lakh shares were there after rights issue. Multiplied by how much period was there after right issue? 10 months were left after the right issue. So 10 by 12. So if you do like this and solve this complete equation of current years, then you will get 15 lakh divided by 5 lakh 87,500 shares. So your current year basic EPS would be 2.55. So current year basic EPS would be 2.55. Same way for the previous year also you have to find out. So for the previous year, the original basic EPS would have been 11 lakh rupees was the profit in the previous year. In the previous year, there was no rights issue. So 5 lakh rupees was what there, 5 lakh rupees, 5 lakh shares was what was there in the company. So divided by 5 lakh shares. So 2.20 was the previous year's EPS. But now you should not do like that. You have to restate it. You have to multiply the rights adjustment factor with the previous year gains. Okay. So you will take the numerator as it is, which is 11 lakh rupees. And in the denominator, you are going to take how much shares were there in the previous year, 5 lakh shares. And you have to multiply it with the risk adjustment factor, which is 1.05, which we found out, right? You have to multiply it with that. And if you then solve this equation, then the previous year restated EPS would be 2.10. It would be 2.10. Okay. And this is how you solve your illustration number 4. I hope you understood this. Okay. Now let's move on to illustration number 5. So in illustration number 5, they are telling you to find out something called as diluted earnings per share. Okay. Yes, now let's start. So here they are saying that the net profit for the current year was 100 lakh. Okay. And number of shares which was outstanding was 50 lakh rupees. Fine. Here they are saying if you do so, then the basic earning per share would be 2 rupees, which is nothing but 100 lakh rupees was the net profit, divided by 50 lakh shares would be 2 rupees basic earning per share. That we could have also found out. Then here they are saying that number of 12% convertible debenture of 100 each. So you had around 1 lakh debentures. So you had around 1 lakh debentures in the company, which were in the form of convertible debentures, which means that in the future, this can become an equity share. That's why this is called a potential equity share. So whenever the concept of potential equity share comes in, the concept of diluted equity per share will also come in. What was the formula of diluted equity per share? Earnings plus savings and interest, how much you are going to do in case of debentures, divided by what was your number of shares in the company plus what will be your potential equity shares. So this was your formula. Okay. Yes. So and they are saying that each debenture which is there in this company, that means thus 1 lakh debentures will be convertible into 10 equity shares each. That means each debenture. So if you see in such case, then if they are saying that for 1 debentures they will be issuing 10 equity shares, it means that for 1 lakh debentures, how many shares will they be issuing? So 1 lakh debentures into 10, which is equal to 10 lakh equity shares is what they are going to issue, or it is a potential equity share. Rather, we can say like that. In the future, this 1 lakh debentures can turn into 10 lakh equity shares. Okay. Then they are saying that interest expense for the year is 12 lakh rupees, which you will be saving if it gets turned into an equity share, and the tax related to this interest expense would be 3,60,000. So this tax, now you are savings. So here they are saying that now you are saving because you are paying this 12 lakh rupees. Now you are able to save 3,60,000 of tax. But in the future, when you are not going to pay this 12 lakh rupees, your income will increase. Now, because this 12 lakh is an interest and it is an expense, your income has been reduced. So that is why this 3,60,000 rupees of tax also you are paying less. In the future, if this 12 lakh rupees of interest is not there, that means this 3,60,000 worth of tax has to be paid more. So your net savings and interest, will be how much? 12 lakh rupees you need not pay for interest, but 3,60,000 rupees of tax you have to pay. So net in the future 8,40,000 worth of savings you will be doing. 8,40,000 worth of savings will be doing. Okay, I hope you understood this. So now let's do the diluted earning per share calculation. First, I told you, right, you have to find out 3 things: numerator, denominator, and then the time adjustment. So numerator, what did I tell you? It is nothing but earnings plus savings and interest. So your earnings, you have seen that it is 100 lakh rupees. So your earnings is going to be 100 lakh rupees plus how much will be your savings and interest? Your saving and interest will be 12 lakh multiplied by 1 minus t, or you can directly do 12 lakh minus 3.6 lakh worth of tax. So it is going to be net of 8 lakh 40,000. So 8 lakh 40,000. So this is our numerator. Denominator, what is it going to be? Denominator will be how much shares were already there in the company, 50 lakh shares. On conversions, how many equity share can be there, or potential equity shares, how much can be there? 10 lakh shares. So plus 10 lakh shares. So if you do so, if you're going to solve this equation, then you're going to get a diluted equity per share of 1.81 rupees. 1.81 rupees. Okay. And here, speaking of the period, here because they have not given or not mentioned any period as such, about the issue or conversion, we are going to assume if from the year start to year end the period is going to be there. That means the entire 12 months will be there. So here you need not take this as a time factor adjustment, because it is anyway going to be into 12 by 12 only. So it's of no use taking up this. So you can just ignore that. Hope you understood this, and this is the answer here as well. Okay. Now next, moving on to the next illustration, which is illustration number 6. In illustration number 6, you have to again find out basic and diluted. Here, in the last question, it was convertible debenture. In this question, it is going to be options. Okay. So starting with the same way, let's first find out the basic earning per share. So basic earning per share is what is the net profit for the year? It is 12 lakh rupees. So take that divided by how much weighted average number of shares were there? 5 lakh. So 12 lakh divided by 5 lakh, 2.4 is the basic earning per share. Now you have to find out diluted earning per share. So for diluted earning per share, you have to again see three things: numerator, denominator, and time adjustment. Starting with the numerator, I told you that in the numerator, there will be no impact. In the concept video itself, I taught you this. Now coming to the denominator. In denominator, what did I tell you? I told you see how many shares are there as potential equity shares. So here they have already told the weighted number of average shares under the options. Under the options is going to be 1 lakh shares. So 1 lakh shares are the potential equity shares, and then you have to multiply it by what is the market price minus the exercise price. So here the average fair value is 20 rupees. So this is your market price, and then market price minus exercise price of 15 rupees. So market price minus exercise price divided by market price if you do. So your denominator variance will be, which you have to add up, that variance is going to be 25,000 shares. Okay. Yes, I hope you have understood this. Then time factor, because nothing has been mentioned in the question, you are going to take from year start to year end. So it's going to be 12 months. So whenever it is 12 months, that is, it is for the whole year, it's not going to have any impact in the answer. So see, your numerator was 12 lakh rupees, which was your earlier profit, plus there is no other impact on the numerator. So directly you will take as 12 lakh. Denominator, already there were 5 lakh shares in the company, plus you have to add in denominator how much? 25,000 shares. So plus 25,000. So if you do this, if you're going to solve this, your diluted equity per share, diluted earnings per share would be 2.29 rupees. It would be 2.29 rupees. I hope you understood this question.